Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Well, welcome to today's show. Today we have Matt Saunders, who is the vice chairman at Newmark Knight Frank, the leading brokerage firm in Houston. Matt has been involved in over $3 billion of multifamily transactions since joining the firm in 2012. Matt received his MBA from Rice University and is a graduate of Texas A&M. He has been married to his wife, Melanie, for 13 years and has 3 sons, Carter, Eli, and Davis. Matt, welcome to the show.
Yeah, thanks so much for having me. Appreciate it.
Awesome. Thanks for being here. So we'll jump right in. So walk us through your background.
Sure thing. And I know we've been talking about doing this for a little bit, so appreciate hanging in there and running through dodging a hurricane for a little bit. So worked out. So I grew up here in Houston and south of here in League City. So been here most of my life. Went to Texas A&M and then Rice University, like you said, for my MBA. Spent 2 years out in California selling semiconductor chips during the dot-com industry, which, kind of was a bust at the time. So good learning experience though, but came back, started working in real estate right after, or actually that last semester when I was at Rice getting my MBA. So I interned with a boutique firm here in Houston and really liked it, really enjoyed just the real estate and the action behind it. And so ended up starting full-time there. And so worked at that firm until 2011 and then moved over to ARA in 2012, which, is now Newmark. Newmark bought us out roughly about 6 years ago or so. So I've been here ever since.
Oh, that's great. That's awesome. And then tell us why you became a broker, what you like about your job, and some of the largest challenges you face in your role.
Sure thing. It's, I like the action and, just doing something different every day. I'm not really the, sit at a desk and count beans all day for, every day, 5 days a week and punch the clock and go in and out. So I just like, the art of making the deal, the art of, or just being with people and meeting with different people all the time. Getting to interact with different types of folks and hear their backgrounds and how they became successful or entrepreneurial and what their stories are. And so it's just, you wear different hats and get to be on the front lines really of making deals and seeing action. And then also getting to, learn about the city and get to see the life of the city and the heartbeat and how things are growing and, new development, things like that. So it's an exciting field.
Oh, that's great. And what are some of the challenges that you face in your day-to-day role?
I guess it's changed as we've gone through from, starting out as a broker and learning the business and learning how that works. And obviously the market is cyclical. And so being in it and, I first started, as I mentioned, as that intern in 2005. And so, I've seen different cycles in the market. And so getting to learn that a little bit and then moving on challenges here where we've taken on, more of a leadership role at the top to where, we're not only on the brokerage side and making deals work, but then also, managing the firm and, taking us through a pandemic and having to make calls that you don't really want to make or furloughs and things like that and come back. So it's been good and challenging at the same time.
Sure. And then you mentioned the pandemic. So how has COVID-19 changed your strategy this year and how you've been marketing deals in 2020?
So it's a big change, obviously, as you know. So we, went out to Orlando at NMHC and I think our team here had, I don't remember, 20 or 22, 23 deals that we had taken out there. And, that's always the kind of the Super Bowl of real estate. So you go and meet with everyone and you're selling deals and come back and go through the marketing process on all of those. And the market's been on fire. It's, since the recession, It's been a straight recovery and increasing market rents and a lot of capital chasing deals. And so, everyone's looking at multifamily and the acquisitions there. So we, came out swinging and then, as everything just came to a standstill and a stop. So, it's different. It really makes you take a step back and kind of, look at things in a different lens or a different perspective, because it's not many times in your career that I think the entire world takes a pause, right?
Sure,
not just where maybe you're changing careers or changing jobs and you get a little break in there, but for the whole world to take a pause, it just made everything come to standstill and look at really what matters in your life and how you're ranking things. And just for me personally, I when you go down the list of faith and family with your wife and kids and, coworkers and work and sports and things like that, and then you look at how much time you spend on each of those, it was really in the reverse order for me, where you're spending more time at work versus 5 or 6 days a week versus say going to church on Sundays once a week.
Sure.
And so it really makes you, if this is the most important part of your life, you spend the least amount of time on it, and then you can kind of go take that and put it in perspective and look at that differently as you move forward. So that's been a big kind of eye-opening situation here with the pandemic for me. But I think your question about how are you marketing those deals differently? Obviously, it's the underwriting has changed a little bit, and lenders and situations have changed a little bit, and so this is really the first push, I guess, since mid-March when COVID hit. There wasn't anything happening until say June or July. Everything was just at a standstill. And then now this is kind of and it's typical. Houston gets real slow in July and August with the heat and summer and people being out. And so right about now is when you start taking deals out for the Labor Day push, where you're going to close deals at the end of the year. And so we're just now starting to take these out over the last, say, 2 weeks ago. Up until now, and we'll take deals out for another month or so to try to close those at the end of the year. So we're I guess we're on the front end of the reaction and how that's going to look. But all so far in the first say 2-3 weeks of it, it's been very positive. We've been very pleased with it. Yeah,
that's awesome. And then let's jump into Houston. So how has the multifamily industry in Houston evolved since you've been in the business? You talked about kind of this bullish run since the recession. Maybe just talk about kind of when you joined, what you've seen happen, and the cycles that you've gone through.
You're right, because I starting in 2005, and it was just a full-on, all-out sprint at that time. 2006, 2007, and that's kind of when I was really just getting into the business and learning. So I feel like you're in the fog at the time, and then as the fog starts to clear and you feel like what you're doing, and then the recession hits in 2008. That's when we had the hurricane and the recession at the same time, and so Houston seems to get these double hits all the time. But anyway, we obviously the crash, and it was tough, very tough for me, because in 2010 I had my second boy in February, and there wasn't anything going on in the market. It was all special servicers and receivers and foreclosures, and the boutique firm I was working for, just the business was a little slower, and so it was hard. If you're a big firm and you want to go sell a deal in Houston, you're forced to sell it in 2010. You're not really going to list it with Matt Saunders at a small boutique shop who's been there for a few years versus a large firm like say ARA or Newmark, where we're at now. So I think I made $28,000 that year. It was a rough go, and kind of changed things a little bit. But seeing the cycles as the market's evolved, and you go through and take deals with receivers and market them, and you get to see like I was mentioning earlier, the pulse of the market as we've gone since 2009 and 10 up to today. And it's been a great run through 2020. And honestly, this is, the way I'm kind of looking at Houston now, it's set up great. We've got good fundamentals here. And I feel like, the market was on this bull run for a long time. And, everyone looks at the history and past runs, and, this has been so many months of positive growth and GDP growth, and we're expecting a recession anytime. And so now I feel like with the pandemic and with COVID, it's obviously giving, you kind of hit the market, and it obviously fell pretty tight in March. I mean, we dropped off and the stock market dropped, and it gave us this little recession, but now we're right back to where we were. And so I feel like it starts over on this whole cycle. And so we can, we can go from here and move forward and look at it. There's a lot of capital out there chasing deals, and it just feels like we're set up for a good run ahead of us.
And where do you see the market going? What's kind of your outlook for Houston multifamily over the next year to 3 years?
Yeah, it's, for me, I think we've got a good runway in front of us. As I mentioned, we kind of hit this little recession that you would call not so much a recession, but just with the pandemic and COVID, and had everyone hit pause for a little bit, and now we're right back. So on new development, a lot of the equity partners there that were looking at capitalizing these new deals have pulled out, and so we're going to have less supply. There's some of those that are still going to go through, and all the deals that were capitalized that were under construction, they're obviously going to continue and deliver. But it is going to slow down quite a bit on that side. And so the way Houston's set up, I mean, the fourth largest city, population growth, very pro-business throughout, Texas and the city in particular. So I feel like we've got a good run in front of us.
And that's great.
Yeah.
And then for sellers, what are the challenges that they're facing now in terms of listing their deals or waiting or?
Sure. I guess one of the major challenges would be the delinquencies that you're going to see right now, because, and that's part of, tying into that last question that you were talking about with Houston and, kind of where I see us. So we are going to have to get through the next, 6 months or so. And once they come up with a, vaccine and everything, and everyone can get back to work. But there's a lot of folks that have been laid off or furloughed. There's been a moratorium on evictions. And so actually this week is the first week that they open that up in Houston, to where you can go and start going to court and evict people for those that haven't been paying. And it's a very difficult and tough situation. But honestly, when you look at the deals and kind of an age delinquency report, and there's a lot of tenants in there that, and everyone's got different stories about collections and how well they're doing, and potentially how many delinquencies they have. But I think that's going to be one of the biggest challenges, is trying to get through that and figure out, what the true collections are at the property versus where our occupancy is today. And so that's one. And then and it's going to take a while for those courts to go through all the eviction process.
Sure,
It'll take 2-3 months or so. So that's one thing we're asking on all of our valuations, is for age delinquency reports, and trying to, really drill down on that. The other thing is with lenders, before, as I mentioned, the market was moving fast and very aggressive. And so lenders have obviously pulled back on leverage. And so, where you may have gotten a 80% loan or 75% loan in the past, now you're at 65 or potentially 70%. And then there's, on top of that, there's some COVID reserves. And so you've got to come up with, an additional $1-2 million or $3 million, depending on the size of the loan, on top of that. And at first they were at 12 months, and they've since pulled that back a little bit to either 6 or 9 months. But it's very sponsor driven. But I think those are some big challenges that we'll see as we move out of this, or still dealing with it.
Yeah, that's really helpful. And then, in terms of buyer appetite, we have COVID, the oil crash in Houston, kind of, the lingering effects, or, Hurricane Laura was, people were thinking it's going to come through here. Fortunately, it didn't. It spared Houston, but, the lingering effects of Hurricane Harvey. So, how has that maybe changed buyer appetite for Houston, or the buyers that are interested in this space in Houston?
People have been looking at just the city in general in a different perspective ever since Hurricane Harvey and the flooding. And obviously we had the Memorial Day floods and Tax Day floods. And so that, affects how people are looking at Houston. And obviously insurance has changed quite a bit. Taxes have changed quite a bit. as everyone knows, the underwriting and on these deals, the taxes are a big key there. So, but I do feel like there's a lot. Houston, like I mentioned, has a long runway in front of it. And so while there are some of those effects that people are looking at in underwriting, they're adapting to it and they're seeing the alternatives. I can go invest in the stock market, or I can invest in different companies, or I can look at different avenues in oil and things like that. And I think multifamily in Houston is still a shining star out there, and I think people are looking at it in a strong light. There's a lot of capital out there, and a lot of folks understand that. Look, I can acquire this deal. It provides a tax shelter for me. It's a good income producing property, and I can take the rents from A to B, or I can do some value add, or I can, increase the value of it. Meanwhile, I've got a loan in place that may be amortizing, and I'm paying that down and earning equity. And so it's just a good investment in the long term, just a cash flow for most folks. And so while there has been some negatives to the city in general, I do still feel like it's when you look at it overall, it's still a great avenue and a great spot to go invest in multifamily here. And like I said, it's got a long runway, in my opinion, on where we are now and catching up to even some of the other Texas cities that are here.
And so speaking of the other Texas cities, obviously DFW gets a lot of attention. So, if you had different clients or investors thinking about a Houston opportunity versus a DFW opportunity, kind of how would you kind of compare and contrast those? Let's say, all things being equal, it's a 200 unit property, B class asset or C class asset, kind of what would you say the merits would be for putting more consideration on Houston?
Yeah, sure. That's a good question, because a lot of Dallas and even Austin, which, the three cities here with Houston and Texas. So Dallas has done a great job of recruiting and bringing in different companies and the job growth, and seem to be absorbing, a lot of the supply that they've had up there. Now, the difference, like you said, in comparing Dallas and Houston is that's a very competitive market there, and the cap rates are going to be lower. I would say 25 to 50 basis points comparing, Austin and Dallas to Houston. And then on the other side of that, you had mentioned, say, let's say a 1980s Class B deal in Dallas versus in Houston. Your price per pound in Houston may be 80 or 90,000 a unit, versus in Dallas where it may be 120,000 or $130,000 a unit. And so you're much lower on the price per pound, and in Houston you've got a higher cap rate, so a higher yield on the deal. And so in my opinion, that just shows you the comparison in the two cities to where the room that we have to grow and where we will be in the next 5 to 10 years. And so just, as a good investment when you're comparing those two, I think honestly all of the Texas cities are great investments, and the growth and everything that you're seeing for being here. I think there's going to be a lot of people moving to Texas after like the moratoriums in New York and some California and exodus that you're seeing even from COVID. I know there's been over 500,000 people leave New York since March that'll never go back, and so people are moving from those states into Texas. And so I feel like that, they've got to live somewhere, right? And so it's a good, it's a good investment.
No, that's great. And then your top 3 favorite submarkets in Houston, what are those?
That's a good question. I like the Heights a lot. I like Spring Branch. Those are both close in. That's probably the easy answer, I would say. The Heights and Spring Branch, because they're close in, and you're just seeing a gentrification there. Kind of the changing of to where some of the old and redevelopment and coming in, and so a lot of that, and I think one leads to the next. And so where the Heights was and all this new developments come in, a lot of those tenants or the people that were living there that may no longer be able to afford it have moved over to Spring Branch. Or even the Garden Oaks area. That's a real strong area as well. To move and migrate that direction. Great schools, and then when you look at maybe suburban You know, I always look at Houston as like these spokes on the wagon wheel, as we've got the loops and then all the different suburbs that are around it. So I really like the Clear Lake area. I like Pearland a lot. I like the Woodlands a lot. Katie's even grown so much. I think there's maybe 9 high schools out there in Katie, and so there's been a lot of supply. It's been a little slow as far as the rent growth and movement in the last say 12 to 18 months, but that area is still, it's just good bedroom communities. And one thing you're seeing with this pandemic is just the you know, it used to be move into the city and live, work, play environment and develop in, you know, in Midtown or inside Loop 610. And now you're starting to see some of this exodus out to the suburbs. And so moving into where there's good school districts like you'd see in Clear Lake and the Clear Creek school districts and over in Pearland even, you know, I think those areas are going to grow quite a bit.
Yeah, no, that's great. Appreciate you sharing that.
I guess that's more than 3 submarkets.
Yeah, no, it's there's a lot of areas that you like. So, you know, on the brokerage side, just walk us through the process of how you get a listing. You know, what is the sales pitch to a potential seller?
Sure. So, you know, I think the David Offey, who started, him and Matt Rotan started ARA here, and one of his things he always said was make best friends with people that own apartments. And so I think, you know, it's all relationships, right? When you're there and you want those relationships and they're long terms, make those guys your best friends. And so when you're first starting out, it's tough because there's, you know, you don't know many people that own apartments, and you're getting to know the players and as you go through your career. And I think I'm in year, I guess 15 or 16 now. So there's been deals that I've sold to a lot of clients that, you know, will turn around and sell those deals back to me, or allow me to go sell the deals again. And so I think that, you know, is obviously big to it. One thing that sets us apart here with Newmark though, and you were mentioning about why they would list with us versus someone else is just the team environment and the way that we handle everything as a team and go out. And it's not just listing a deal with Matt Saunders, but you're listing a deal with Newmark, who has 6 brokers on the line who are all out there to help each other. So our compensation is all part of a pool. And so, you know, my partners here, like Russell and Zach and David and Thomas and all the guys that are in here, if they have a deal that they bring in, I'm going to get paid on that deal. And so I'm incentivized to go bring buyers to it. Whereas in other shops, you're kind of doing this is my deal approach, and I don't want to share it with you. And so, you know, if you bring the buyer, then I have to split the fee with you, versus if I bring my own buyer, then I'll keep the fee to myself. And so it just kind of keeps people from holding those cards real tight to the vest, and everything here is an open book. And so we share, and to be honest, there are so many clients out there, and there's so many deals across Houston. It's impossible for me to cover all those by myself. I can't go out there and get to know. I mean, look, I can make calls all day long and talk to different owners, but I'm not going to have a relationship that 6 guys can go have with everyone that's out there, right? That's kind of I would say the main key there is just that team environment that we have.
And I definitely have to compliment you on that. I mean, very professional organization, and the folks that I've interacted with have been, you know, top notch. I mean, just responsive and very professional, very thorough, very detailed.
Yeah, thanks very much. That was set up in the beginning, like I mentioned, with David and Matt, and the culture that they set up here. And, and we've done our best to carry that forward, and you know, hopefully we can continue.
No, that's great. And then as vice chairman, you talked a little bit about kind of, you know, an element of management and training and so forth. But how much cold calling do you still do?
Probably not as much as I should. That was one thing that when I first started was just drilled down on making cold calls. Here's a list and go make these calls. And you know, it's definitely you know, dwindled down quite a bit. But I still do it. You know, now what I'll do is let's say I have a listing that's right here in the Galleria, then I'll take and run a 3-mile radius, and I'll call the owners within that. And so there's cold calls that happen in there, But I really look at those as more of a warm call. Whereas, look, I've got this deal and I'm pitching a deal and, here's what the market's going on, versus in the very beginning when I didn't know anyone or didn't have any listings, I'd make calls and say, hey, Mr. Smith, would you like to sell your property? No. And then they hang up real fast. And so it's just, it's a little different, but I would say that, the cold calling has dwindled down a little bit, but we try to look at it more as some warm calling, right?
No, that's great. That's great. So some people try and call owners direct to buy properties. What are your thoughts on that?
They do. And, people can obviously get out there and do what they'd like. The problem is, when those guys are out there doing that, like we had a client actually that I had called about a deal, and it was an off-market deal. And so I called and he said, oh, I already know that owner direct. I'm just going to call him. And so, when that's the case, he's not going to get any more calls from me as far as buying a deal or
Sure.
looking at an off-market deal or anything like that. It just won't happen anymore. So it's just, a lot of people do that. I think a broker obviously is there for a reason and adds a lot of value to the deal, but I guess you can't really control some of those folks and what they're doing.
Sure. And then if we switch gears to underwriting, so, walk us through your underwriting process when putting together a BOV, what things kind of are important that you all focus on and
Sure.
kind of how maybe that's changed with the pandemic here.
Definitely. So, as I mentioned to you a little bit earlier, this last, say, 2 to 3 weeks, we've definitely had quite a bit more activity as far as the underwriting, and the market was dead for a long time. And then now you're starting to see folks, I think they're just getting tired of the quarantine and everything. And so they're coming out and saying, hey, what's my deal worth today? And can you underwrite the deal? So we'll take the financials, we'll get the trailing 12 financials, and we'll get the rent rolls. And like I mentioned, always try to get age delinquency reports today, and maybe a lease trade out report. What have my last 25 leases look like? And are they higher than previous leases? Just to get a snapshot of what's going on today. And then obviously we'll underwrite those deals and throw them in the model. We look at deals as a trailing 3 income and then a trailing 12 on expenses, and then we'll adjust for taxes there. So as you know, taxes are big, and it's been a problem with the appraisal district this year, just hammering apartments, unfortunately. Sure. And I know that's a big game as far as protesting those, but we typically underwrite all of our deals at 85% to purchase price. And so we'll take our trailing 12 expenses, adjust for taxes, and then apply a cap rate to that. So just depending if it's a class A, B, C deal, how that would look. So as I mentioned to you, with the taxes, and then insurance is obviously really big too, because we've had some flooding, and there's bayous and everything else in Houston. So you look at the floodplains, and the insurance companies have really been increasing those premiums over the last, really 2 years. But this last year, everyone we've talked to has seen, 15 to 25% increases in insurance, which is big, unfortunately. Sure. So, we'll put all that together and then run through that with the owner and talk to him about where we think the values are today, and, go through it.
Awesome. No, that's really helpful. And then in terms of rent growth and reversion cap rates for Houston, how do you think about that? And, how does that vary depending on, B class, C class, and submarket?
Yeah, actually, that's a good point, because that's part of the underwriting as well. Previous to COVID, we were underwriting about call it 2 to 3% rent growth, depending on where you are in the city, on a lot of these deals that we were valuing. And now we have actually adjusted that to just a plain flat rent growth. So we're leaving for the next year, we're leaving that the same, and then throwing in, maybe that 1 to 2% rent growth a year from now is where we've been doing on our underwriting. So we plug that in. And then on top of that, the value add, to where folks may come in and want to, let's go throw in $5,000 to $8,000 a unit and turn the interiors and push our rents $150. And so a lot of those terms we've pushed out as well, maybe a year from now or so in the underwriting, to where you can go get those premiums a year from now. And it depends, each of it is submarket by submarket or deal specific. It's if it's a Class B deal or Class A deal and things like that. So that changes. And then those you're talking about like the exit caps. The same thing, submarket by submarket, but maybe a 5.5 to 6 cap on the exits, just depending on kind of where you're at there.
Okay, no, perfect.
What class of the deal?
No, that's great. And then, in terms of managing the kind of the expectation gap, during this period where, you'd mentioned age delinquency reports and lease trade outs and, effectively kind of tapering rent growth for the first, year or so, and versus seller expectations and buyer expectations. How are you bridging the gap? And I guess you're in the midst of it as you just launched a number of deals.
That's right. But it's a good point. There is a gap for sure. That was the biggest hurdle was, when the pandemic hit, all the sellers were still expecting the similar prices as they were in the first quarter. And all the buyers were expecting a large discount there. And so I think that's part of the reason why there wasn't any activity really from March all the way through August right now to where we're starting to see more activity. I think we had something like 24 deals under contract, and 20 of those fell out when COVID hit. And so, the ones that made were either inside the 5-yard line, and so they were able to just kind of get right there at the end. But anything that was, just getting going or had been going or doing the due diligence period, those all fell apart. A lot of folks lost earnest money, and anyway, it was a struggle. So we've since then started to put some deals back together. Over the last few months to where without going through a full marketing period, maybe the backup buyer is still there. Typically on those deals, we've seen about a 5% discount on them. And so, and each one, like I said, depends on the deal, 4 to 5 or so percent discount, and throwing those back together. But then, we'll see now as we have just launched quite a few of these deals, if there is a large gap there and kind of where we're at. I do feel like it's going to be tough to hit some of the premium numbers and it just, as we touched on earlier, these delinquencies that are in there, and the leverage is just not quite what it was. And so, I mean, interest rates are extremely low, and I think that's what's keeping cap rates where they are. So I don't think cap rates have really moved that much at all. Having the interest rates low, which is a positive, but it is a little bit less leverage plus the reserve you have to put in. So it's more out of pocket, and then your returns are going to be a little bit lower. So people are going to expect a little bit lower price on the deal. And so I think that's where we're going to see. I really don't feel like all the deals that we're taking to market right now are going to sell, to be honest, just because we won't hit those premium numbers. But there are quite a few deals that are out there, where there are sellers and they're still going to fetch great prices. There's a lot of capital chasing deals. There's a lot of buyers still out there. It's more on the private side of capital and buyers chasing deals than the institutions right now. As Houston had the oil crash on top of the pandemic, a lot of folks have kind of redlined Houston, or at least just put it on a
watch list.
Call it a watch list to where they're, look, we're not going to stretch really hard on a deal and go get it. We're going to underwrite the deal, and if it makes sense, we'll bid on it. And so I think that's going to just throw us into that, market pricing versus like premium pricing.
Sure. No, I appreciate that. So you've invested in some deals, right, Matt?
I have, yes.
Okay. So what 3 to 5 things do you look for when considering investing in an opportunity?
When looking at deals that I invest in that, as we were talking about earlier, it's always been on the LP side. And I do feel like you want to, you get to know the deals, you get to know the city, what deals will perform better, or, where the gentrification is and value add, but then also on the operators and if they're going to sink money into the deal and do it the right way versus if they're going to fee it to death. Like there's some guys that it's all other people's money, and they're going to take an acquisition fee, and they're going to take a construction fee, and they're going to take an operator management fee, and they're going to take a disposition fee, which is fine. People need to make money. I have no problem with taking fees. It's just, are your limiteds in mind, and are you looking out for yourself, or are you looking out for your investors kind of deal? And so, you get to know the right operators and the folks that run the deals right and deals that way. And so I have thrown some money into some deals as we talked about earlier. But on that target to where, the guys that are going to operate it correctly and manage it correctly and the guys that you trust and believe in. I'm not completely investing in a deal. It's really investing in the people, right? And so it's when you meet those people and have the relationships with them, those are the ones that you want to invest with.
Yeah, that's great. I appreciate that. And then you had mentioned a little bit about off-market opportunities, and how do you decide who you're going to show those to? How do people get in that inner circle?
Right. So that's, again, it's the relationships that we talked about earlier, and it's the guys that have performed well on a deal. If it's someone who is going to put a deal under contract and then extend it 17 times and retrade and just, really give us a problem versus someone who you can approach, who has equity and has their debt lined up and who can go perform, those are the guys that you want to, reach out to and see if you can put a deal together, right? So, and it changes. It's, there's always your top clients who are there, but then somebody may come in with some hot money and need a certain deal size or with a 1031 exchange and things like that. And so it moves around a little bit, but mostly it's, the relationships and performance.
That's great. And then if we just switch topics to tours, so what are some of the do's and don'ts on a property tour?
Right. So really, I would say some of the big issues that we've had is just time, as far as taking up time with the manager and being respectful of her or him who's managing the property. So we've had guys come in and, they want to sit down at the desk with the manager and go over 6 pages of questions, which I can probably help answer most of those before we even get there. And then, walk through the property and ask 100 questions that way and go through it. Which is, you need to get to know the deals, but the manager also has a job to do there where she's running a deal. And so we definitely don't want to, take up just an absorbent amount of time from them. The whole point of these tours is you can underwrite a deal and you can look at a deal and it may fit your criteria, but when you go out there and tour it, I mean, there's nothing like seeing the real estate in person. And so you that's a must. You have to go see the deal and see the area and what the drive-in looks like and how the deal performs and what the value add is. So typically we'll go in and we'll show 2 or 3 units where there's a classic unit and an upgraded unit. And here's what you can do to the interiors to help push your rents. And, this is what the deal looks like. And here are the amenities. And you could take this club room and turn it into a fitness center or something like that, which is what you want. But, there's, I don't know, 20 tours or so on these. And the manager obviously has to get through those. And so we don't want to just take up an hour and a half and run through. It's more of we joke about it being a first date kind of thing in our office where you kind of come in and get to know the deal a little bit and look at it. And then, you can ask more questions later. If you have additional questions that I can help with, obviously, then that's what I'm here to do and go work through that. And so if there's line items on the financials you don't like or something that's confusing or something you need to drill down into, then we can certainly handle that from the office. Sure. Versus perhaps with the manager that may be there that may or may not know the specific line item that we're talking about.
And then how much work do you expect potential buyers to do before the property tour? What are your expectations?
I would hope that they would, kind of run a first pass on the deal and at least do some preliminary underwriting to see if it fits the criteria and if it fits the area. And what you don't want is for someone to, come out and tour the deal that's never even looked at financials and never done anything. And then they get there and they say, I would never buy in this submarket, or I don't like the schools that are here. Which that easily could have been avoided just by,
saved everybody's time,
giving it a preliminary pass. Right. So that's what I would hope as you go through there to that you can find and be able to, at least give it a first look and say that, look, this fits most of the boxes. Now, when you go on these tours, obviously it helps refine your CapEx budget. Maybe the entire roofs need to be replaced, or maybe the siding needs to be replaced, or if they were all just replaced, and I can take that out of my underwriting and lower my CapEx budget. And so I understand that you can't, just completely drill down and define it, but you can at least give it a first pass and see if it fits your criteria.
Oh, that's helpful. And then what are some key questions to ask on a property tour?
You want to, like I was mentioning about the CapEx, you definitely want to, look at, say, how old the roofs are, or some interiors on the value add. I definitely think how much with the premiums that you're getting on those value adds, and can the tenants pay for that premium? One of the questions we get sometimes is with the manager is, if you had a blank check, what would you do?
Sure.
And it's good to hear from the manager and her perspective on it, because she's there living and breathing the property and knows the tenants and kind of the feel for what's there. So, which is a perfectly good question. Feel free to ask that and go through it. And I think obviously the rent comps are big. You want to find out who their biggest competitors are, what rent comps are in the surrounding area, and the tenants, as the manager's there and a tenant walks in, they may have just come from another property or two. And they obviously look at some of that data. And so you want to know what the biggest competitors are, and then you can go look at where their rents are, and if they've upgraded, or if it's, maybe a lower class property and getting the similar rents, then, you can understand that there's some room and able to drive the investment there.
Yeah, that's great. And then what are the key factors when you're awarding someone a deal?
So we look at, I guess, almost like a buyer interview at the very end. So we'll go through a marketing period and take offers on the deal, and then we'll go to like a best and final. And so when you get in that final round, let's say there's, 3 or 4 people in there, then you want to make sure their equity is lined up. And so whether they have the equity themselves, whether they're syndicating the equity, whether they have an equity group in tow, like a JV partner or someone, you want to know how much work that partner's done on the deal, if they've even seen the deal. We've been on buyer interview calls that said, where you're talking to someone and he said, "Oh yeah, I love Austin. I would buy that deal tomorrow, and we've already underwritten it. And the deal happens to be in Houston, so it's you want to go check and see." Wow. As long where the equity's coming from, and if it's real, and if they looked at the deal, and then obviously the debt, they need to go through and have you sized it for debt? Have you are you looking at a bridge loan or an agency loan? Is it short term, long term? How are you looking at the debt on it? And then as we talked about earlier, a couple of key factors also in the underwriting are insurance and taxes, and you want to make sure that they're looking at those in the right way. Have you got an insurance quote on it? Are you working on 6 deals currently to where it's going to take up a lot of your time and you're not going to be able to focus on this deal? Or, do I buy 2 deals a year? And it doesn't mean people can't go do it. There's teams of folks out there with companies that go buy deals all the time. But you just have to get to know the buyer and how they're looking at the deal, where their equity and debt comes from is kind of the primary.
Yeah, that's helpful. And then, you talked about some of the, how you run your process. How many offers do you typically get on an average deal in Houston?
It varies a little bit between if it's a straight down the fairway, say 90s deal with value add, you may have 15 to 20 offers on a deal, versus, perhaps it's just a coupon clipper type deal, or maybe it's a tougher area. Then, we could have 10 offers or 12 offers or something like that. But I would say on average, it would probably be in the 10 to 15 offer range.
Okay.
As I mentioned before, we haven't really done a full cycle on a deal since COVID hit. And so we're just now seeing how that goes. Now, the initial reactions from all of these have been very positive and strong. So I feel good about it. I think it'll be right in the same range. Should be. But that's about on average, I would say.
Okay, no, that's really helpful. Are you seeing anything different in terms of terms in the term sheet that people are offering?
The earnest money is a little bit less aggressive on it, so you're seeing not as much hard money in terms of right out of the gate, day one. Folks have been doing that maybe at 10 days or 15 days, or maybe an access agreement and then going non-refundable, to where pre-COVID we were seeing that quite a bit because it was very competitive. And then on the other side, and the lending, as we mentioned, you're seeing about 30 days due diligence, and then where typically we would see like a 30-day closing after due diligence, now it may be 45 days, just because the lenders are taking a little bit more time than they were previously. And so, as I mentioned, we're just going through these first rounds of processes, and so we'll be able to give you a little bit more stats, as we go over the next few weeks. But I would say it's like a 30-day due diligence and either 30 or 45-day closing right after that. A lot of folks build in an extension, maybe a 15-day extension there. And the amount of earnest money is about the same, 1% to 2%, depending on the size of the deal. But as I mentioned, it's some deals we've seen hard money day one, which are those deals that are, just the down the fairway, very aggressive deals versus deals that, maybe a little on the fringe. And so we're seeing less hard money on those.
And then, you run a pretty streamlined process and have that buyer interview. So, when have you seen deals fall out of contract, and what were the circumstances there?
That's a good question. So as I mentioned before, we may go through and qualify the buyer, and he'll tell us who his equity comes from, and then the equity may find another deal, or the equity may back out, and then the buyer's left to go, fill that void. And so we've seen that happen. You try to qualify and get everyone, put all the cards on the table so they know what's going on. And so we've seen some guys come in who have retraded maybe on roofs and the age of the roofs, and they say that the roofs are old. And you can point to it and say, look, they're pitched roofs. You saw these when we toured the deal, and you looked at them. We talked about how old they were. And so some people will go through and do that anyway and have it fall out. But, as I mentioned about COVID, we lost quite a few deals there, and that's just not something that anyone can really predict. But for the most part, we've been on a very strong run the last, say, 2-3 years, to where we really haven't lost too many deals to where they've fallen out. Most of them all have made, I would say, above 90%, 95% even track record there.
Yeah, no, that's great. So as we turn to wrapping up here, what are your 3 biggest lessons learned from your time in multifamily?
Man, that's a good question. I think, as I mentioned, I think relationships is one, and reputation. I think you always want to be truthful about things, and real estate's a very small world. And so you want to be upfront and truthful about everything. And when you run a process and we go through a best and final round, and let's say there's 3 guys that are going after the deal and all want the deal, then I try to remove myself from it versus, look, buyer A, B, and C all want the answers to the test, and say, look, if I get to 40 million, do I get the deal? If I get to 41 million, or where is it? And so, if we get to that point, I try to just say, look, here's the deal. Put your best foot forward. If you lose the deal because you're not, it's a price that you couldn't get to, that's okay, and you're fine walking away. I don't want you to come back and say that, you didn't tell me what I was supposed to do or anything. Sure, so that I think
it's a good way to handle it. Sounds like.
Yeah, I think reputation is big there. I think there's cycles that obviously, as we talked about before, to where as that moves up and down, and as the market moves, and you kind of see the ebb and flow of real estate and the city, and even with oil, you see cycles all the time there. And so now that I've been through several of those cycles and knowing it, and not extending beyond your means or anything, and knowing that the next one could be right around the corner, like with COVID right now, geez, that wasn't even a slowdown or anything. It was just a complete 180 shift that turned everyone, the opposite direction. And there wasn't much you could do there. So, but it's been great. I love being in multifamily, and the camaraderie and the friendships that I've made, and just the action of the deals has been really the most part. It's exciting. It's fun to come to work every day, and I really miss the office environment, to where the water cooler talk, or just coming in and interacting with all the team members here. which I know we'll get back to shortly, but it's going to change that perspective a little bit. So it's been good.
Matt, this has been fantastic. We really appreciate you being so generous with your time and answering all these detailed questions. So how can listeners get in touch with you?
I can, read off the emails or anything, or if you want to put it on there, that's great. I'm
Happy
more
to
than happy to talk to people about it. And that's part of this deal too, is just, just learning and talking to folks and seeing what they're looking at. And I'm always happy to help people get to know the city and get to know what deals may work. And just when you go to a new market, it's just Houston is, it's very submarket specific and it's with taxes and insurance and no zoning. And there's a couple of things in there that are different that many people might not know about. And so, always happy to talk with people about it and help, just give them some knowledge about the city.
That's great. Well, thank you so much for your time and being so generous with your time.
Yeah. Thanks, Ryan. Appreciate it. And, look forward to the next one, man. Thank you.
Awesome. Thanks again.
Yeah, take care.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.